everyone, and welcome to our summer webinar series. I am Kate Coffey, the Director of Marketing for UST Education. I will be your host for this session today. I am joined by William Duncan, who is our Digital Content and Strategy Manager guru. William, thanks for helping out today. Thank you to the McKelvey Group for sponsoring today's session. They are truly subject matter experts in their industry. I think you'll find the information very valuable. Our UST Ed series is powered by our parent organization, US Trans Corp. UST provides payment processing services to associations and B2B clients. We are honored to have Matt McKelvey, president of the McKelvey Group, join us today. Here's a few of your course objectives, but today we'll be learning what an NICRA is when it's needed, the pros and cons of having one, and recommendations for how to prepare the NICRA. A quick few reminders for the group. We do need your full name in your Zoom tag so that we can identify you when issuing credits. If you want to go ahead and drop, if you need CPE credits or CAE credits in the chat. For those credits, you do have to answer a majority of the polling questions in the chat. There is no right or wrong. You can always put I don't know or NA if it doesn't apply to you. If you are not here for credits, please answer as well, because your input is very valuable to the group and to your instructor. Your first polling question is coming up in just a second, so get ready. We do rely heavily on the chat. It's where everything happens. If you have questions, comments, observations, today, even corny jokes, you can drop those in the chat and we'll be monitoring those as they come through. So here it is, your very first polling question for your CPE CAE credit. What would you like to get out of this webinar? So I'll go ahead and read some of those. Matt, if you want to take charge of the screen share.
Happy to.
What is it?
See my screen okay?
Yes, we've got it.
All right, perfect. Then I just want to make sure I can see the chat here. Just going to let me reorganize my screen here. Good. Okay.
Great.
I'm just reading some of the comments from folks. This does help me a lot in the chat, folks, as to what you want to get out of the class today, because as you know, most webinars, unfortunately, a lot of them you can just get the PowerPoint and you've got all the information you needed. I like to make sure that we get you something actionable, something very tangible for you to spend your time with us today. So this really does help. And I'm just saying, general knowledge, how to calculate. We will talk about calculating a NICRA at a point. Understand the subject. So this is good. Most of the things, what a NICRA is, that's actually a good question to have. I will answer that one for you. No question. Going forward, pros and cons. Yep. And there are pros and cons to everything in life, right? Okay, some folks are looking for new federal work. We're definitely going to touch on that a bit. So good. I'm seeing a pretty good list of things here. So I think we're good to go, Kate. So I'm going to go ahead and get started with the presentation if you guys are ready. Okay, let's go forward. So welcome to the NICRA. So as Kate mentioned, we're going to talk about various subjects. Here's how the webinar is organized, 10 very basic parts. Introductions have started, and then I've gotten some information for you. I'm going to introduce myself in a moment. I'll define the NICRA clearly. I'll tell you what the prerequisites are for a NICRA. I think that's important to know what you need to do to actually even pursue a NICRA. I'm going to talk a little about the costs. I don't know how many of you are accountants versus business owners versus business development or funding folks, but I'm not going to be getting into the accounting per se today. That's not what this webinar is about. I'm going to focus on these numbers and for terminology's perspective and from a general understanding of it. But that's how we're going to cover the different types of costs that are required to be able to do a NICRA. I'll talk about unallowable, which may be an unfamiliar term for those of you that are not familiar with federal work. And then ultimately how to prepare a proposal and what you do until you have one. And then we'll go to questions and wrap up. But I want to be very clear, we don't need to wait till part 10 to get questions. If you have questions while I'm speaking, Jacelyn over here is actually going to be watching the chat. She'll interrupt me and let me know if there's any questions, and I'm very happy to do so. I think that this will be more beneficial to everyone if we actually have some interaction as we go versus me just lecturing to you, okay? So without further ado, I'll get going here. And again, Jacelyn, if you could just make sure to let me know if there are any questions coming in, that'd be perfect. All right, so quick background for me. I've been doing this for 30 years, which is getting depressing. Every time I do these webinars and classes now, every year the numbers tick up to the point where at one point I felt like I had too few years and people wouldn't take me seriously. Now I'm worried about becoming a geriatric on the whole thing. But 30 years of doing this, I've worked extensively with government and commercial companies and clients, so I do understand both the federal world and the commercial world. Do a lot of pricing. Pricing is, in federal contracting terms, the way you actually respond to government requests for work. And what that really means when I say pricing is I've got a really good background in accounting, finance, and operations, and those really do tie together if they're done well. All contract types, agencies, and geographies is just what happens over 30 years of doing this. I do teach regularly. Honestly, this is my favorite thing to do. If I could find a way to do only teaching, I would do it. But unfortunately, I've got to pay the bills sometimes too. So I do some billable work. But the point there is that I'm not just an academic. We actually, my team and I do this every day. So when I talk to you about the NICRA today, I'm going to be giving you an actual experience that we have with small businesses, with larger businesses, and dealing with NICRAs in general. That's about it. But again, it's cross strategy, business finance, pricing. It's not to float my boat. It's to let you know that I do have some background in what we're talking about today. That's it for introductions. So I do have another polling question for you. I call it number one. So I already scripted the numbering on all this stuff because Kate called the first one number one, but this is the number one in my slide deck. So if you can just throw in the chat, I'd really love to know if your organization has a NICRA. And if not, so that'd be A. If not, let me know if you're pursuing one, if you're considering it, or you have just no idea. Some of you already answered this in your objectives for the class, but this is the first polling question to kind of get a feel for what we're dealing with. So appreciate it. And I'm going to look to my other screen here to read the chats. I'm not looking away from you all. I'm just reading the chat information. Great. So there's an A. There's a couple of AAs, but primarily this is in the CDs. Oh, I'm really happy with Eric. I actually don't know. Love that. Thank you, Eric. An E answer. That's outside the box. I love outside the box stuff. Okay. Mostly it's a no, but considering. Samuel, thanks for letting me know you have one. So this is great. And Abby, not sure. No problem. You'll understand what this is, and you can check in with your team at some point. Good. So I think this is really well built for this. This webinar is really well built for this audience. So we'll keep going forward then. So let me define it first. What is a NICRA? Okay, and then it's basically a negotiated indirect cost rate agreement. I will apologize right now. I have a habit having worked in the federal contracting world for so long of falling into acronym speak without hesitation. I don't even notice that I'm doing it. So one thing I'd ask you all, if I put out an acronym or say something that terminology-wise you don't know, throw a question in the chat. I guarantee you, if you don't know it, multiple others don't, and it's not because I'm trying to sound like I'm smarter. I'm kind of blind to the idea that I didn't even use the term. So terminology is a big part of this. Anytime you hear me say an acronym or something else, throw it into the chat and we'll go there. But what is a negotiated indirect cost rate agreement? This is from the USAID, which is one of the agencies that does a lot of work with NICRAs. It's basically a document that summarizes the indirect cost rates that will be negotiated. That word negotiate is important. I'll get to that in a second. Between the federal government and an organization. Could be a nonprofit, could be an association, could be a contractor, meaning a for-profit company. It doesn't matter. NICRA can be used by any of these organizations, but it's between the federal government and someone wanting to work either through grants or contracts with the federal government. Okay, that's a really formal definition, but I want to make it a little more clear and a little less formal. Basically, you have direct costs as an organization, those costs that you can really identify to a job. We'll talk about that more later. And indirect costs, the things it takes to run a business. And indirect rates are your way of recovering your indirect costs. And the reality is, if you can have negotiated rates with the government, when you submit a proposal for a grant or submit a proposal for a contract, by having a NICRA or any kind of negotiated indirect rates, the government will accept the rates you submit. That's the most important thing. You don't have to justify them anymore. You don't have to provide supporting information. You don't have to argue about them. Fundamentally, once you have a negotiated indirect rate, you can use that for the period of term of that NICRA. So there's a lot of value in that when you're bidding work, because it means that the government can focus the evaluation on the direct costs, the things that you are doing directly to deliver or to support that grant or contract. That's what this is really about. We'll talk a little further about de minimis rates and what happens when you don't have a NICRA, but the idea here is a negotiated indirect cost rate agreement. I'm going to pause for a second, make sure there are any questions about where I am so far. because we're just in the definition stage. Okay. One thing I should have actually said also, I'm sorry, in the introductions, there are two things that I want you to know about me personally. Number one is that when I talk on and present on these pages, and when I answer questions, I'm going to do my best to be very clear with what's a fact versus an opinion, meaning I'll call out what I'm saying, it's my opinion. If I don't say anything about it, it's basically a fact or a commonly understood approach and process within the federal government contracting arena. But I will do my best to say if there is an opinion of mine, I'll offer as my opinion, not as a fact. And then if you ask me a question that I don't know the answer to, which it happens, and it's actually, I love it because I learned something new. What I'll do is I won't try to answer it here on the webinar. What I will do is I will go off, I will find the answer, and we will send the answer back to everyone that's attending today. That way you're getting an actual answer, not just making me feel like I know more than I do. So please ask the questions. And I guess the last thing I should say also is you will get a copy of this PowerPoint presentation. We will send out a copy of it today to everybody, both the actual PowerPoint itself. And I know that you're going to get the copy of the recording of this webinar as well. So you will get all that, so you don't have to worry about asking about it. We'll have that out to you. Okay. All right, let me keep going on the definitions. Some of these terms I know can be confusing, and that's why I want to point them out at the beginning. The word cognizant, and it has to do with the cognizant agency and the cognizant auditor. What this really just fundamentally means is when you're doing work with the federal government, there is going to be an agency, one of the agencies with the federal government, in which your organization has or will have the largest dollar value of your awards. It's your biggest federal customer, for sake of a better term. That is the agency that you're supposed to negotiate your NICRA with. All right, that's their obligation if they're the largest holder of funds that are sent or provided to the organization. Every now and then, if an agency wants to pursue a NICRA with your organization and they're not the largest, they might do so, but fundamentally this is it. So if your primary work is with Health and Human Services, that's the group you would focus on. If your primary work is with the Department of Defense, that's who you'd go to. If it's with NOAA or NASA or any of the other ones, that's your cognizant agency. And for those that don't have federal work yet, you can assume who your cognizant agency would be based upon the type of work you would be pursuing. Okay, that's what that means, a cognizant agency. And you'll also hear the term cognizant auditor. And a cognizant auditor is the group within that agency that actually does the review, does the negotiations with you on accounting functions. All right, it can be agency specific. So, for example, within USAID, they will have an audit group that may do this. It could be another government group, such as DCA. DCA stands for the Defense Contract Audit Agency. That's the largest audit group in the government. That's because the Department of Defense is the largest agency in the federal government. But sometimes an agency will actually subcontract, for sake of a better term, the audit work to another agency. And finally, because there is a limit to the number of auditors available within the government itself, many agencies now have external agreements with CPA firms, primarily CPA firms, to actually perform the audits for them or on behalf of the agency. You don't know who you'll be working with, but fundamentally, it can be any of these three groups. The key thing is all of these auditors follow the same guidelines. There may be some format differences or some document support requests that are different based upon the agency, but fundamentally, the approach to getting a NICRA and submitting a NICRA proposal is the same across all federal agencies. Okay, any questions here? All right, let's keep going on the definitions. I don't want anyone to get hung up on these terms right now, especially if you don't even know what a NICRA is. I'm now thinking about all these other terms for rates. I'm just putting it on here, and you'll have this as a reference because it's important to know there are different kinds of NICRAs for different purposes. Now, the vast majority, the ultimate majority of organizations deal with that first line, the provisional rate. What that basically is saying is that with a negotiated NICRA, or negotiated indirect cost rate agreement, the government will establish indirect rates for your organization that you can use for pricing and billing purposes throughout the next period, usually the fiscal year. And actually, it's almost always your fiscal year. The idea of provisional rate is you don't know what your actual rates are going to be, but it's a good guideline by which the government agrees that you will probably hit, and they'll use that for billing purposes. And then at the end of the year, you'll go to the second line, which is you'll finalize your rate with the government the next year and make any and be able to either pay back or recover any costs that were over or under billed. The idea really fundamentally is that this is used for forward-looking purposes, not historical purposes, the provisional rate. Let's see, I seem to see a question here.
Yeah.
And I'll go ahead and read it out just so everyone knows it. Can the cognizant auditor be in a sub-federal agency versus the largest federal agency the sub is under? For instance, SAMHSA and HHS. Yes, it's possible. Usually, the audit group is a agency level group, but they may be broken down into sub-agency or groups within that agency. So absolutely, my recommendation is if you're trying to identify who your audit group is within a federal agency, every website for every agency will list their audit group. You can just make a contact to them, reach out to them and say, we're looking to submit a NICRA based upon this. Who is the right point of contact? It's not hard to find. It may not be the simplest thing to do, but it's not hard to find. That would be my recommendation. Hope that answers your question, Tim. So I talked about provisional rate, and I'm talking about the final rate. Again, the final rate is basically once your fiscal year is closed and your books are finished for the year, a negotiated final rate will be done. Predetermined and fixed rates are relatively less common than provisional or final rates. I'm glad I answered your question, Tim. But predetermined and fixed are fundamentally different. A predetermined rate is where a rate is agreed upon between the federal government and an organization, and that rate is used for the next year. Will not be adjusted based upon actuals. So if you run your costs lower than what your predetermined rate is, you may have more funds available to reinvest in the organization. If you run higher, you may have to find ways to overcome that gap. But a predetermined rate is fixed for sake of a better term, which is a little confusing because the last term is called a fixed rate. What a fixed rate means, it's the same thing as a predetermined rate, except if you have an over/under, you would capture that and recover that in the following fiscal year. I really, again, for the sakes of an entry level or an opening discussion about webinars, don't worry about really understanding all these things. I would suggest that the most likely purpose you'd have for a NICRA would be provisional rate, which is this first bullet. And it's really about being able to bid and bill on work going forward. I'm going to pause for a moment.
We do have a question, Matt, from Samuel. How much deviation do you see from the provisional rate versus the final rate?
That's a great question, Samuel, and you're going to get the wonderful answer of it depends. What I mean by that is it really comes down to what changes in your organization. Your organization, if it grows because you land some new contracts or grants that really change the structure of the organization, or if you lose some, or if you have a hiring approach, it really depends on what you actually, how well you planned and projected, sorry, not how well, how similar the following year will be to the previous year. The closer you are in kind of a run rate business, the more likely the variance will be smaller. What I tend to do this is an operational point, is I keep track of my indirect rates as actuals on a monthly basis and a quarterly basis year to date. And if it's starting to become a very large variance, and I'd say think greater than 5% variance, this is my opinion, a greater than 5% variance, I'll notify my contracting officer and have a conversation with them about what they want to do, whether they want us to change our bill rate or not to be closer to zero at the end of the year. But it really is an it depends question. Does that make sense, Samuel?
Yeah, that makes a lot of sense.
Okay, great. And I see Tracy has a question as well. How do rate I currently have? Okay, so if you've never had a NICRA, you'd have to calculate your indirect rates internally. And if you don't calculate your indirect rates internally on a regular basis, I'm going to ask you to hold off on a second for this question because I do talk about that a little bit later. But if you're not sure and you do have indirect rates, the best way to find out is to speak with your accounting or finance teams. They should have that information readily available and say, okay, here's what our rate is, and here's how you can calculate it. Not trying to be flippant, every organization is different, but that's usually where it's held, is by the accounting and finance team. Okay? And again, if you haven't calculated it previously, that's okay. There's no rule in the general world of accounting and finance that you have to have indirect rates. And again, I'm going to go into more detail later, so I don't want to get too far ahead of it, but you run your organizations usually as you are required to by your clients, customers, or by regulations. It's when you get to work with the federal government that indirect rates become a requirement in how you actually do the work. And it's actually a good thing, but I will talk later that I believe indirect rates are also extremely valuable for organizations, even when they're not working with the federal government. And I will talk about that a little bit later on, okay? Tracy, did that answer the question at least at some level for you at this point in time?
Well, I am the accounting department, and we have our first grant, and we have an indirect rate. Okay. I wasn't involved on how it was calculated, so I'm trying to determine which one was used.
I understand that. So I was a little worried when I said you talked to your accounting folks. I figured you might be an accounting person. Let's get through the webinar. And by the way, you ask the question again later at the end if I haven't quite covered what you're looking for. Okay. And then there's always the possibility if you want to talk offline afterwards, I'm happy to do so. Okay.
Thank you.
You're welcome. All right, let's get out of definitions. Definitions get boring. So let's talk about what is a prerequisite. Okay, these are basically what do you have to have in place, and what do I recommend you have in place before you pursue a NICRA, because these are the things that auditors are going to ask you for. This first bullet's important. It says you must have a grant or contract with the federal government in order to request a NICRA. Now, I know there are probably a lot of you out there, and from the discussion of the chat earlier, that you may be starting to pursue one, you want to pursue. Okay, so it's this chicken and the egg world where you have to bid on work, but you don't have an indirect rate agreement yet. So how do you do so? I'm absolutely going to talk about that later. So just understand that in order to submit a NICRA request, you have to have a grant or contract with the federal government. But I'm going to talk about what you do until that point later on in the webinar. Okay. The next bullets are all the way around how does the government know and how does the government get comfortable with your indirect rates and indirect costs. So your system has to segregate direct, indirect, and unallowable costs. I'm going to define those in a few minutes, okay? But has to segregate them. When I say segregate, ideally by a chart of accounts line. For those accountants that are on the call, it's your COA, your chart of accounts. It's having a financial line that is limited to all costs of that line are either direct or indirect or unallowable. There's no mixing of them. That means you'd be able to calculate your indirect rates based upon your general ledger and your income statement or your statement of operations. All right. And there's a lot more to this. Getting into the details of all this can be really a webinar in and of itself, but just be aware that's what you have to be able to do with your system. All right. You're also required to be able to allocate your direct costs to each grant contract or program. This is usually less of an issue for organizations that are commercial because you probably do this anyway in order to support the requirements of a grant or to at least know where your costs are going. But when you do go with federal work, you are required to be able to allocate your direct costs to each grant contract or program. Okay. I sort of already touched on the blue box here. The general ledger should allow for the direct calculation of indirect rates. If your account system segregates direct, indirect, and allowable costs, you can directly calculate them. So that becomes kind of a combination of the two. One of the most important things in government contracting in general, beyond the NICRA, beyond everything else, is the government wants you to treat and allocate costs consistently. This is encoded in the FAR, which are the Federal Acquisition Regulations. It's in the CAS standards, or the cost accounting standards. It's in all throughout the federal contracting world. The idea is be consistent in how you treat and allocate costs. Now, in a commercial world, that's not as important, usually. I would say from a finance person it is, and from a manager and from an owner perspective, you want to be able to say, okay, we do things consistently so I can trust in the numbers. I know what they mean when I look at them, but it's not necessarily a requirement. I mean, it is under GAAP to a point. I don't want to say it's not there, but it's not with the same level of rigor that is with federal contracting. So that's an area where you have to be very consistent and understand very well where your costs are coming from and how you're treating them. And finally, one of the most important things is you must have your accounting policy procedures documented and you must consistently follow them. All right. So there is a wide range of what it means to have a accounting policy procedure manual. It could be a few pages long. It could be 100 pages long. It could be 1,000 pages long. It really depends on your organization and the complexity of your accounting. But the basic idea is that if you could hand that manual to another accountant who's not part of your organization, they'd be able to understand, and this is an opinion or kind of a relative term, 80% of what you do in the accounting department. In other words, you could hire somebody, give them the manual, and they could take on 80% of the work based on following the procedures. So it is an important thing to do. Those last two bullets talk about consistency. This is a Matt McKelvey phrase, and my team is tired of hearing it, but I've always said this. In my opinion, it is better to be consistently wrong than inconsistently right. And I know that sounds funny, but again, it's better to be consistently wrong than inconsistently right. And the reason is, if you're consistently wrong, there's a process, and you can fix it. And once you fix it, you'll be consistently right. If you're inconsistently right, it means there's not a process, or at least not a recurring process, and it's much harder to fix those things. All right. So in my basic small-minded way of looking at it, you just want to make sure you're consistent in how you treat your accounting, cost, transactions, allocations. Any questions at this point? I'm going to pause again for a moment here. Time-wise, we're doing well. All right, so let me get into a little more of the detail. I'm going to focus in the next few sections about direct, indirect, and unallowable costs. I'm sorry, I did get a question. Can a NICRA be used by lower tier subcontractors? Brad, that's a great question. The answer is yes. If you're a prime contractor or the grant awardee from the federal government and you have sub-awardees or subcontractors or any organization that's below you, you are actually, in the terms of government contracting and government grant process, acting on behalf of the government, and therefore you're expected as an organization to treat the subcontractors the way the government treats you. And so that means that, yes, ideally your subawardees or your subcontractors have a NICRA or a similar type of negotiated rate agreement. That means that you can accept their prices a lot more readily. If they don't have one, you have to talk about things, and again, we're going to talk later about this in the webinar, but like the de minimis rate, which some of you may have heard of, or you might have to have a government assist audit. But yes, in an ideal world, your subcontractors have, and subawardees have a NICRA. In fact, when I'm doing price proposals, I always ask for the subs to provide a yes or no, as they have a negotiated indirect rate cost agreement. And if so, what's the date and number of that agreement, so that I can then present my proposal up. Does that help, Brad? Okay, great, thank you. All right, so yeah, let's go ahead and move on to direct. Actually, I'm going to pause for 1 second. One thing I didn't say at the beginning, the term NICRA, and I mentioned that's a negotiated indirect cost rate agreement. There is another term that's heard a lot of times. It's called the forward pricing rate agreement. This is more of a Department of Defense and some other agency terms. It's basically the same exact thing. Not all the rules are identical, but for all intents and purposes, a forward pricing rate agreement means you've negotiated forward pricing rates with the government to be used provisionally and or in proposals, is the same thing effectively as a negotiated indirect cost rate agreement. So if you've heard the term FPRA or forward pricing rate agreement, we're using all the same terminology here, meaning the underpinnings of it. Okay, so if I fall into it and accidentally say a forward pricing rate agreement, it's only because I'm working on several right now for some of our clients, and the NICRAs are a little lower as far as the count. It just goes back and forth on me. Okay. All right, let's see here. Cool. Let's go on. So here's the definitions. A lot of words on this page. I'm going to take a few minutes and go through this in detail. All right. So what is a direct cost? A direct cost, by definition, in the Code of Federal Regulations, are costs that are specific, identifiable, and incurred to provide services or products for a grant award, service, or activity. Okay, that's the formal definition. Informally, if you can attach a cost from payroll and timesheets, or invoices from suppliers, vendors, or anything else to a specific program, that is direct. All right, we're going indirect next, but if you can take a bill from a vendor and say, this is uniquely in our something to pay because of program A, or if you get a salary because someone charges time to program B, that is a direct cost. You pause on that. Any questions on that definition? I'll give you some examples in a moment here. Again, I'm just looking left to the chat window. So again, I'm not looking away from you folks. All right, so some examples are direct labor. Direct labor is the labor, and labor could be, in this definition, W-2 labor or payroll labor. It's your employees that are charging time to a program. Now, I know in the commercial world, not everyone uses timesheets. I'm going to talk about that a little bit later. In the commercial world, you might allocate based upon a person's role or a percentage of their time, of their salary to a certain job. With federal contracting, timesheets are an absolute requirement. They're the key. And then time coding is how you actually allocate labor. So if an individual works all of their time on a program, except for paid leave, that's pretty straightforward. If they work on multiple programs and also may have paid leave, the timesheets is how you can allocate their dollars or salary or pay costs to those various jobs. So that's how direct labor is identified, is by timesheets. Subcontractors, consultants, subawardees, anyone that's another entity that's doing work to deliver the grant or the contract. That's not really the same thing as vendors. Okay, I'm going to talk about them separately here in a second, but subcontractors, consultants, subawardees, they're doing work to support the scope or the objectives of the grant or contract. Those are direct costs. Ideally, your subs, consultants, and subawardees would submit invoices each month separately for each project they're working on, so that you can easily assign each invoice to one of those jobs. That's the idea of direct subs, consultants, and subawardees. Then you have other costs, such as direct travel incurred specifically for a program, training on that program. You might have facilities required just for that program, materials, supplies. Those are all supported by vendors or organizations that provide that support or service or product to you. If they're uniquely identifiable to a program, they should be there. And finally, there are some other costs that can be direct. They're usually unique program costs, such as the program management on a specific grant or job. You might have unusual fringe costs, especially if you're doing international work. There might be a location in which there's a fringe requirement that's not the same elsewhere. You could have whatever it might be, but it's only on that one job, so it doesn't make sense to spread it elsewhere, maybe for that job specifically, and sometimes local taxes as well, depending on what taxes you might or might not pay. The way I kind of look at this is that if you had no grants and you had no contracts in your organization, you wouldn't have any direct costs. Okay, that's the idea. Though once you start getting grants and start getting contracts, the cost to deliver those are your direct costs. So those are some examples. Let me pause there. Any questions on the examples? Okay. Now these considerations, these are opinions from me, from both myself and the McKelvey Group. All right, we believe the organization should, especially when they're doing work with the federal government specifically, but in general, strongly recommend charging everything that is appropriate as a direct cost directly. Meaning, we really strongly recommend charging things directly, even if you could recover them in another way. I believe it, and in my experience, it's better for government approval because they can approve that cost as being delivered on that job and know, hey, so-and-so worked on this job. Yes, I know they worked on it. I know they worked the hours. We're approving that invoice, that payment. It's better for indirect rate calculations, meaning your indirect rates are lower. The more you charge directly, the lower your indirect rates are. It's a mathematical algebraic thing, which you'll see in a few minutes. And finally, and this is my personally strongest opinion for this, is that it makes it better and easier for you for future pricing of opportunities. In other words, if you know what it really takes to deliver a program or a job or a contract, when you go to price the next one, you're better positioned to price it accurately. And you don't have to run around trying to figure out how to make up for being too low or too high. All right. And the only other consideration I want to really point out is that if you're going to make an accounting change, for example, if something you've charged historically that's not direct, you're going to make it direct, just make sure you formally document the change, the date of it, and implement the change across all programs. Okay, that goes back to that consistency point. Let's see, are audit costs direct? Great question, Tracy. Audit costs are usually not direct. Usually an audit cost, and if you're talking about the organization audit, the annual audit, that is usually going to be an indirect cost that's spread across the contracts because it's not usually done for an individual job. If there's an audit required on an individual grant or contract, there'd be a good argument that that would be a direct cost. Does that make sense, Tracy?
Well, if you only have one government grant, can
You only have one government grant, then basically it's the same thing, right? So, but I would expect if you're only going to ever go after one grant, you could charge it directly. But if you're going to pursue future grants, I would charge that indirectly because eventually, as you have more grants or contracts, you'd spread that cost over all of them. Does that make sense?
Yes, thanks.
You're welcome. Performance audit, that's correct. If I say your name wrong, I really apologize. Is it Manouk? I'm sorry, but yes, performance audit costs could definitely go under direct costs because that's a performance audit on that particular job, contract, grant. Thank you for that. And by the way, anyone else that wants to call out, that's actually very valuable. That's helpful. So thank you. All right. Any other questions on direct costs? If not, I'll move to indirect. Okay. Indirect costs. This is really crazy, but those costs that aren't direct, guess what they are? They're indirect, and that's really, really, really complicated. Actually, there's three types of costs, but I'll tell you in a second. Indirect costs, really, this is per FAR. Again, FAR stands for the Federal Acquisition Regulations. If you ever need to fall asleep, the best book you'll ever read is the FAR. And I know no one reads books anymore, but the great articles you'll read are the FAR. The FAR is basically the core regulations for how the federal government contracts and works with organizations. Any costs not directly identifiable with a single final cost objective, that generally means a job, a contract, or a grant, but identified with two or more final cost objectives would be an indirect cost. And so in other words, the cost can't be identified specifically. There are three primary types of indirect costs that most small to mid-sized organizations have. You may not have these three. You may have more. All right. There's no absolute requirement about fundamentally having these three, but these are by far the most common. And I'm going to go into a little bit of detail here. These are the indirect costs. Fringe or fringe benefits are those costs that are basically benefiting the employees paid for by the organization. It includes things like paid leave, which are holidays, sick, vacation, or PTO if you have it. Could be jury duty, military leave, whatever it might be. Whenever you're paying somebody and they're not working, that is a fringe benefit and is collected in the fringe indirect cost pool. Benefits, and I have the asterisks. I'll go through some of the benefits. So it's medical, insurance, medical, dental, vision, that all that insurance, the company paid portion of that would belong in your fringe rate. Anything related to a 401k match, life insurance that the company pays for, tuition reimbursement, anything that's a benefit that's fundamentally provided to the employees that the company pays for as a cost associated with it belongs in the fringe pool. The employee paid portions of payroll taxes and benefits, they don't go into your books because they're taken out of their paychecks. They have a gross pay and that's taken out. So you don't worry about that. This is really the company paid portions, which is why they have the asterisks for those two. Okay. And finally, what are some other costs? This is where different organizations might have different decisions. In some organizations, they include their incentive compensation as a fringe benefit. There could be other things that are less common, like related to a collective bargaining agreement, that there are some minimum requirements for pay or for benefits that you have to have as a single payment out. Really, in your organization, the idea is if someone works and they're paid $1, they get something for that $1, and this is what those costs are. The rate would then be applied to that $1, but fundamentally, these are the costs that go in there. All right? Fringe rates are usually, and not always, but usually the highest cost you'll have as far as a rate goes. The smaller the organization, that may be less true because your indirect costs may have a smaller base to go across, but fundamentally, fringe is usually the highest cost, highest rate percentage within an organization. Then the government does split out to facilities administration. So if you look at the CFR and you look at a lot of they talk about the two primary secondary accounts for nonprofits, associations, et cetera, are facilities administration. For a for-profit company, you might see overhead and G&A. All right. So administration isn't necessarily one single rate. It could be multiple rates. I'm going to talk about that when I get into more detail about the indirect rate itself. But really, these are the categories of cost for indirect costs. Facilities include things such as rent. Now, if you own a building, it could be your mortgage as opposed to that, but most organizations tend to rent versus own, or they have a separate entity they rent from. But rent, furniture, equipment, the telecommunication costs associated with that facility, supplies, any labor to manage that facility. That could be security, it could be IT services, it could be janitorial, custodial, depending if you have them as an employee or as a vendor. But labor costs, there could be some allocations that go to that facility pool from elsewhere, and other things that you can have that are just relatively unique. It could require secure locations for classified work. It just depends. But your facilities costs can only pool together into one bucket. All right. And then the third group is administration. These are your costs for running your company or your organization. In my example before, I said if you had no job, if you had no grants or contracts, you wouldn't have direct costs. But in theory, you'd still have administrative costs. If you had no programs at all, you still have to have something to go out and find the work. You have some people that are being paid. You may have to be made a loss, or you might have to get something as far as a loan from ownership or whatever it might be. But fundamentally, you have administrative costs. It includes labor. Labor can include executives, HR, accounting, legal, business development, and or fundraising. It could be a number of things, but there's fundamentally labor associated with running the organization. One of the most common next level up is professional fees. These are outside professionals, CPA firms for doing your annual audits or your tax if you're a for-profit company, or tax filings. Could be, you might be outsourcing things like HR if you're smaller, or legal costs. So professional fees fill the gap for any labor that you don't have internally, or some very specialized external resources. Insurance here means business insurance. It's not medical insurance. Again, medical insurance belongs in fringe, but this could be business insurance, key person insurance, things like that. Marketing costs belong in administrative numbers as opposed to anywhere else. I mentioned accounting, legal, and HR already. That could also be systems. It's not just labor. It could be accounting software, legal software, HR software. Again, allocations from other buckets, and then anything else. There could be a million other things. I mentioned that a lot of companies, or no, some companies put incentive compensation in fringe. Many others put that to administration. It just depends. The key is you define this, all right? You define what goes in each of these buckets, and you consistently charge it. And please note that the sub-bullet I have for administration, that's where I did talk about overhead or G&A. Again, terminology is just that. It's what makes the most sense for your organization and your peers. If the organizations that you're bidding against or competing against for work normally have overhead and G&A costs, you probably should be similar to that. If the organizations you compete with or work with regularly have just an administration, an F&A, or an administrative rate, or none, use that. So there's no hard and fast rule as to which indirect cost pools you should use, but finally, these are the ones that are the most common. I'm going to stop for a second. That was a lot. Any questions on that? Are your eyes glazing over for your non-accountants right now? I assume they are, because this gets really pretty boring for non-accountants. All right. What I mentioned earlier on a previous slide is that if you are an accountant, by the way, and you're in charge, this is where you'd like to have each of these lines be a separate or a group of separate chart of accounts lines. I'm not saying you have to roll all your paid leave into one chart of accounts line, but for all your various paid leave accounts, make sure they only have paid leave in them. Your benefits, payroll taxes, that's usually pretty straightforward, but you want to make sure that you don't make it too detailed. No one wants to have 10,000 chart of accounts lines, but you also want to summarize things up when you're mixing things. The one key one is labor. When you're dealing with direct labor as a cost or direct cost, or labor in your in your facilities or administration, that is your W-2 labor. This is employee labor. In order to do your indirect rate calculations easily, you should always have that as a separate chart of accounts line. So don't mix payroll labor with 1099 or subcontractor labor. Those should be separate lines in your chart of accounts. That's a really best practice, and you have that going forward. It makes things a lot easier. All right. Let's see. Oh, thanks, Abby. I appreciate that. Congratulations on not being an accountant, although I am one, so it's not a bad thing. Glad it's still helpful. All right, let's go on to what are called unallowable costs. And this is a very uniquely government term. And I want to be very clear before I get anywhere else. Unallowable costs are perfectly legal. They're perfectly, you can absolutely incur them. We're not saying that they cannot be used or cannot be incurred. What we're saying unallowables by the government is there are costs that are specifically identified under the federal acquisition regulations and the cost accounting standards, which the government will not reimburse organizations for. The reason is the government doesn't view that they get a benefit for these costs. Because they don't get a benefit for these costs, they don't want to pay for them. All right, and I'll go through some of the examples here in a second. But unallowable costs, to be very clear, are defined by the FAR and FAR Part 31.2. And I can get into all kinds of FAR parts, but that's the part that defines it. Agency FAR supplements, and what I mean by this is every agency of the federal government uses the FAR as its floor for regulations, but then each agency has its own supplement to the FAR that could further define or further regulate bidders that work within that agency. So the supplements might have more definition around what's unallowable. And finally, in any specific contract or grant, they could list items that are expressly unallowable on that grant or contract. The third is the least common way of doing it. The most common is the first, which is the FAR. The second is with including supplements. The third is with specific terms in an agreement. All right, let me go over some of these examples. I find examples are the best way to explain why the government doesn't want to pay for unallowable costs. I'm going to start with fundraising and development. For nonprofits, this is one of the most common ones and one of the largest ones. Why does the government not pay for fundraising and development? Because fundamentally, the services being provided by the organization are being paid for by the government. Therefore, any fundraising and development for basically any funds beyond that don't benefit the government. So the cost for getting those funds are not meant to be paid. So the government does not pay for fundraising and development costs for a nonprofit. In the for-profit company, that relates to advertising above there and marketing costs that are not related to a specific opportunity. Here's the idea. If the government's going to reimburse you for your costs and you're going to spend $50 billion on advertising because they're going to pay you for it, the government doesn't want to do that. The government itself doesn't feel like they should have to argue and determine what the right level of advertising is or the right level of fundraising and development. That should be up to the organization. So they do not allow those things. Premium travel, the government does not pay for premium travel, and there are some exceptions when there's nothing else available. But really, for fundamental terms, the government's not paying for premium travel, so it's an unallowable cost. Alcohol, the government doesn't view that alcohol as benefiting them, so they're not going to pay for it. While you might view that as company morale, it doesn't work the same for the government. So alcohol costs are separated. So, for example, a lot of government contractors, when they have a holiday event or events, they'll separate an alcohol bill from a site bill or from food bill, depending on the nature of the event. Interest. So this is interest paid for by an organization. Why doesn't the government pay for this? Well, because, again, the government doesn't determine what your funding sources should be or what your capital structure should be as an organization. And if they have two bidders side by side, they don't want to pick one or the other based upon the fact that one uses debt and one uses equity. So interest is expressly unallowable by the federal government, again, with minor exceptions. But if you've got a line of credit, a business loan, et cetera, that interest is not allowable. You cannot charge it back to the government. There are other things, and it, again, depends on the organization, depends on other pieces of it, but fundamentally, these are the kinds of things that are unallowable. Let me pause for a second. Okay, let's see. The premium travel will be allowable under certain circumstances. That's a great question. Let me clarify that. The only time premium travel is allowable if there is no other option for normal, regular travel, economy, basically travel, and a requirement for the person to be available at a certain place and time is made. The government's basically acknowledging that if there's nothing else available, you can use premium travel, but you'd have to support it, and you'd have to justify it and document it on a case-by-case basis. And believe me, they're going to look to see if there was another option. Now, today, with the way travel is, what's the most common way premium travel becomes an issue is not because it's planned ahead of time, it's because during travel, flights are canceled, connections are missed, and it requires a premium payment. That's where you see it most of the time in submission for it. But again, you'd have to document the heck out of it. You'd have to really prove why the government should be paying for premium travel. Does that answer the question? Yep, great, perfect. Other questions on unallowable costs? Again, hopefully I'm not killing you all with accounting stuff here. But here's the thing, all right? Unallowable costs should be segregated within your organization by either a chart of accounts line or sometimes by departments. Depends on how your accounting structure is. Again, I'm talking to the accountants here mostly, but if you have departments within your organization that use the same chart of accounts, if you have a department that's purely unallowable, such as fundraising development, you could still keep that in all the various chart of accounts lines, but just know that that department is unallowable. I'll talk about that in a minute about the idea of adjustments to your general ledger, but that's really what this is all about. Now, for the smaller the organization, the less likely there's a lot of unallowable costs, but as you get larger, these can be significant. What does this mean? It means that these costs cannot be charged directly to a program or indirectly to a program. So how do you cover them? Well, you have to cover them either through profit if you're a for-profit company or excess funds or additional funds, or if you're a nonprofit, you have to cover it through unrestricted funds that are not provided by the federal government. So that's the point, that this can be a significant number, and you need to be aware of it. And I will tell you, in any kind of NICRA or any kind of accounting system audit, this is one of the very first things the government looks for, because they never want to have to justify to the taxpayer why they're paying for alcohol, why they're paying for premium travel outside the exceptions, why they're paying for interest. So they definitively will look at this. And so I would tell a client that does not have any unallowable costs, go buy a case of beer, put it in a line, give it away to somebody, and then just say that was an unallowable cost just to have something. It's tongue in cheek, but the idea is you should have something that's unallowable on your books, if at all possible, to show that you know what they are and you can track them separately. All right, let me pause. Any questions at this point? I can't see faces, so I don't know if you're yawning or you're smiling, so I'm going to assume smiles. That's the way I am. All right, let's go to polling question number 2 here, folks. And please answer in the chat. And again, back to Kate's point at the very beginning of this webinar, this is for your certification and for you to get your credits. Does your organization currently have any grants or contracts with the federal government? A, yes, no. B, no, but we're pursuing them. C, no, but we're considering them. D, no. And some of you already answered this, but you have to answer it again, but it's just it's a checkbox item for you. All right. Well done, William, being very clear. All right, aid contracts, good. There are definitely some here. This is great. Good. Another 5 seconds or 10 seconds for me to answer. Okay. State Department, yep, NICRA is very much a part of that. All right. Okay, you can keep answering in there again. Go ahead and answer in there, but we'll keep going with the webinar so we don't run out of time for questions, because I want to leave plenty of time to go forward. So this is going to take us a little time to walk through. This is the indirect rate itself. So I talked about, let me go back, I'll show you. I talked about direct costs, right? Direct costs here. Then I talked about indirect costs. Now I'm going to talk about the indirect rates. So how do you calculate your rates from your indirect costs? Okay. And I'm going to focus on the 3 primary indirect pools that I talked about previously. Again, you may have more or fewer rates depending on your corporate structure or your organization structure. That's fine, okay? But this is the best way I can share with you in a generic format or a general format what you should be looking for. So reading from the left first, then we'll get into the details. The indirect rates, they're the mechanism by which organizations capture their indirect or recapture indirect costs via the direct cost charged to a grant or contract. It's basically the premium above your direct cost that you got to cover. In the commercial world, in the world, it's basically your margin, right? It's your margin on what you're paying somebody. But in this case, it's actually an indirect cost. And if you apply your organization's indirect rates to your organization-wide direct costs, so in other words, use your statement of operations or your P&L statement, and use your indirect rates on your direct costs over that fiscal period, the dollar value you get back will equal the total of your indirect costs. It's a recovery mechanism. It's not a way to make more money or lose money done correctly. It's a recovery mechanism. All right, again, direct costs are easy because they're charged to a program directly. Indirect costs are spread across programs, and across all your programs, you should be recovering your full indirect costs. All right, and this is not indirect costs don't include unallowable. It's your indirect costs. All right, and I do believe, again, this is a strong opinion of mine, but I fundamentally believe that indirect rates are an incredibly valuable accounting approach, regardless of whether or not your organization has a NICRA. Okay, I actually started out my career as a pricing analyst out of college. Didn't know what it was. I answered had the paper, and I didn't even know what a government contractor was, even though I grew up in Maryland. I didn't know. But I took the job and I learned a lot about it. Then I worked for commercial companies for a while, and one of the ones I went to did not actually utilize indirect rates, and so their pricing was kind of arbitrary. They basically figured out their direct cost, and they put a percentage on top of it that they wanted to make. But it was a guess. It wasn't really based on anything. So therefore, when they were doing it, they were spending a lot of their time managing themselves to profitability, or manage themselves to margin, or manage themselves to break even on jobs, as opposed to using indirect rates to decide what it would really take to do this, and therefore making sure their pricing was more accurate. And then they became much more focused on delivering once we started doing that. So in my opinion, whether you pursue a NICRA or not, the value of this webinar might be just thinking about your indirect costs in the way of saying, what if we do calculate an indirect rate? And we apply that to our direct costs when you actually are figuring out what it's going to take to deliver something in the future, and use that as a basis for estimating. It can be really, really, really valuable, okay? So how do you calculate indirect rate? Well, all rates have two components. They have a pool and a base. It's a fraction, algebra, basic math. There's a pool and a base. I've already provided the pools to you. The pools are on this slide right here, this indirect slide. These are your pools. These are your costs. So the indirect costs create the pool for an indirect rate. The base is different depending on the type of indirect costs. So I'm going to go through each one in order here. Fringe rate. You have the fringe costs, which is paid leave, company paid benefits, company paid payroll taxes, etc. The base is all of your waged labor, all of your payroll labor. Why is it that? Well, because your benefits are paid to all of your employees. Now, some employees might opt out, some employees might take more, some employees might have a family plan versus an individual plan, but on the average, your fringe costs can be spread equally across all of your labor, called the fringe rate, for what it takes to pay an employee. This is an incredibly valuable rate for you, because when you hire somebody or you're paying somebody, you're not just paying them their salary or their hourly rate. You're paying their salary at least plus their benefits. So I use this in every company to say, when you're going to go hire somebody, you have to know what it's going to take to break even on that person. It's not that. So let's say your fringe rate, I'm making numbers up here, and this is a common number, 35%. So 35% of every dollar becomes fringe. So if you hire someone for, very simple math, $100,000, you would actually pay them $135,000 for salary plus benefits. That's the real value of a fringe rate, even beyond a NICRA. Now, where it really helps with a NICRA or helps with the government is then when you're actually doing direct labor, you can apply that fringe rate to your direct labor, have your direct fringe as a direct cost that's charged directly to that program, and it doesn't sit in your administrative cost. So it makes your indirect rates smaller, your facilities and administrative. So there's a real value of charging fringe directly. So fringe is one of the first things I recommend you do. So if you have if your chart of accounts has fringe costs kind of spread everywhere else, group them together. If you group them all together, have a total fringe cost for the pool, and you have a total total labor cost for the base, you can use your indirect rates day in and day out. Okay. Any questions on fringe? Now, one thing I will say is some organizations will have more than one fringe rate, usually the larger they get. The reason is because some set of employees have different benefits than others. It's most common when you have a large group of people who are either regular employees or exempt employees, and then maybe collective bargaining or union employees. And union employees get a different benefit structure than the regular employees. Or you might have a lot of exempt employees and a large number of non-exempt. This gets into a lot of different accounting detail and payroll detail, but fundamentally, if you have really different benefits pools for different groups of employees, it would potentially make sense to have separate fringe rates. It would absolutely make sense to track those fringe costs separately so you could calculate if you wanted to, but at a minimum, you should have them. Any questions on that on fringe? Haven't heard any questions lately. Someone just write something in chat like, I'm bored or something. Anything? Not anyone in the chat? Okay, so I am losing everybody. Okay, let's keep going here though. Facilities rate. I don't think I'm losing everybody. Thanks, Kate, you saved me. I just want to make sure you guys still hear me. So facilities rate. Facilities is a separate rate because it can be a very large cost. Okay. Thanks, Eric. I appreciate that. Facilities rates are for the cost for housing your employees and potentially subcontractors and delivering it. Your pool, again, are the cost related facilities. The base, there are different options for this. The most common base that I see is labor dollars. Basically, you spread the indirect facilities costs over the labor dollars. My opinion, the second option is the better one, which is labor hours. Usually a facility doesn't relate to a person's salaries, meaning someone making $30,000, someone making $50,000, someone making $70,000 a year, don't necessarily always have different space. I mean, maybe at the executive level you can see larger space, but in general, as an average across the organization, space isn't dictated by salary. But hours can be the better way to spread it so that if you work 30 hours on a job, 30 hours on G&A, you can spread those costs separately. Hours are really the best way, in my opinion. And there could be other ways. You could do a percentage of allocation that, hey, 50% of our indirect facilities costs go direct, 25% are to administrative. It's up to you. The simplest and the best way is labor hours or labor dollars. Okay. But the application here is can be both direct and indirect. So you could charge facilities directly if you have a basis for doing so. And you make a decision whether you include it in the facilities pool or not. So again, this is really accounting geeky stuff at this point in time, but just be familiar with the term facilities rate. Okay. Let's see here. Got a question. I have a lot of push that honestly like square footage. Okay, that's a good point, Courtney. Square footage can definitely be, if an individual works and they're primarily in a role that puts them into one grouping as direct or indirect potentially, square footage can definitely be used. And honestly, you're going to deal with auditors. Auditors are people. So whoever you deal with the most and whether they've said, sometimes discretion is the better part of valor. And if that's the only way you can get it to go through, you can do so. So it's not that it's wrong. I do fight very hard for labor hours. And here's why, by the way, I do that, is that labor hours can also include subs or 1099s that use your space. Whereas when you're doing square footage, you may not be able to do that as easily or readily because they may be part-time or partial. But really, I understand that, Courtney. I'm not saying you're wrong with that. Sometimes it's not just raising the idea of doing it a different way. It's showing why the government would benefit from having it a different way. And that's always kind of the negotiation approach is how does it benefit the government? And if it can be more accurate, that's the argument I would tend to make. And I've been successful most of the time, but not all the time. All right. So great point, Courtney. And then I've seen out there that says orange just use a large expense drivers and use them as a base. Yes. And you're right, is that labor might be the most common way because you know what? It's the simplest application methodology. It depends on your organization. What I like to feel and say for the base of rates is what makes the most logical sense. What is that pool of costs? What are those indirects really doing for your organization? So fringe, to me, labor makes perfect sense. Facilities, to me, hours does the most base, but again, labor can be as well. Administrative, it might be labor, might be others. So that's a great point. And the reality too is salaries tend to be your largest cost for most services organizations. I know if you're a manufacturing group, that might not be the same, but if you're primarily services based, labor tends to be by far your largest dollar amount, which is I think why that is used the most commonly. Okay, so you're not wrong if you're doing it differently. These are my examples and what I would suggest that are probably the optimal way to do those. And yes, 100% in the chat, it all comes down to consistency of allocation. Always comes down to being consistent. All right, finally, the administrative rate. It's the pool cost we talked about. Stripping out any unallowables from there, but it's the pool cost. And there are very different ways to do the base. And I'm not going to be able to get into all these. And there's pros and cons to each. This could be an entire webinar on its own. But this is for terminology's sake. You're going to hear probably primarily three terms. One is simplified, which relates to what was just said. It's basically using labor or your total cost as a basis. And then the second is going to be a modified direct total cost base. Modified total direct cost base. I just said it out of order, MTDC. That's the most common for nonprofits and associations. Basically, it's taking your total direct costs and stripping a few of them out. I'm going to talk about that in a second. But a modified total direct cost base. The others could be a TCI, total cost input, or value added. If you're a commercial contractor, that's more common. But fundamentally, whatever the most appropriate base organization, you choose it, you sell it to an auditor. They don't agree, they're going to argue and negotiate with you. But fundamentally, the first time you do a NICRA, this will be defined by that negotiation exercise. Okay? And then you apply it, it depends on the base and some allowable costs. I have some couple of questions. Let me jump back to this real quickly here. With the shift to work from home and reduction of square footage, won't be relevant more. That's a great point, Laura. And that's one of the things that a lot of my clients are struggling with right now is that space is changing from the historical traditional cubes and offices to co-located space, a mix of home versus office. And it's going to be important that you all consider what's the most appropriate way to allocate your facilities costs in your organization. Your facilities costs, if they're there for everyone to use, right, but not everyone's using at the same level, square footage may be a harder one to justify than it was in the past. Even in this case, labor hours are be tough because if you have people working from home, you'd have to have a different charge code for them versus people working in the office in order to allocate it correctly. So yes, that's a great point, Laura. And it's a world that's being basically organizations are dealing with it first and the government's coming around to it. The government's the slowest roller on this. That's not in a negative way. It's just, it's gargantuan. It's historical. They use what they've done before as the primary basis for going forward. I get that. But this shift of facilities use, and it's not settled. It's going to keep changing, I think, and keep modifying with the pendulum back and forth for the next few years is definitely something to consider. I have one very large nonprofit client. We worked with them this year on their NICRA, actually last year on their NICRA, excuse me. And that was one of the biggest challenges they had is during COVID, they had all their facilities costs. They'd always allocated it out based upon labor dollars, but they had a much reduced grant base during this time. And so a lot of contractors were going, they were spending the same amount of dollars, but not getting the same benefits. So they're changing to moving to basically a co-located office where there's more hoteling, more mixed use, and they can't figure out yet how to do it. So we talked with the auditors about how we were going to do it, propose it for this year to get ahead of it. But that's a major issue for a lot of organizations. Tim, let's see your question here. Tim asked a question on what's the range of rates you see in different industries. Yeah, you know what, let's save that for the question and answer session. I'm very happy to talk to it. The challenge is it's different by industry, it's different by size organization, it's different by niche, it's different type of organization. But I can give you some ideas of what I see, and at least gives you a feel for it. And there are some maximum rates that federal agencies will accept. I'll talk to that in a few minutes. They'll actually be part of the, what to do before you have a NICRA. Okay. I pause for just a second to see if there are any other questions on indirect rates. Again, you don't know how to go calculate indirect rates today. This isn't a detailed webinar. It's a summary level, so you're getting an idea of what these things are. Okay. All right. Let me go on to just a more text-based explanation of indirect rates. Okay, and modified direct total cost base. For the CFAR, so this is the Code of Federal Regulations. This is really detailed, but the base includes all direct salaries and wages, applicable fringe or direct fringe, materials and supplies, services, travel, all those costs I had, except subawards and subcontracts up to the first $25,000 of each subaward, or subcontracts. So there are some things that are excluded from that base. And so subawardees and subcontracts, and in some cases other costs, the government's basically saying that you as an organization are operating as a pass-through entity, and therefore they don't want you to spread all of your cost over all of the subawardee dollars or grants. So there are some calculations you have to have. This again is for another day, but if you are working on a modified direct total cost base, or might be, this is one of the really critical points to make sure you're tracking in your system is how do you know when you reach the first 25,000 for each subawardee or each subcontractor in the program under your company's operations. Make sense? Completely nonsensical to you guys. All right. The direct costs have to be specifically identified. That we already talked about, but they say it again under the modified direct total cost base. And they all must be necessary for reasonable performance of the federal award. That's what's basically talking about unallowable costs. So this kind of summarizes all the things we talked about before in one slide is what you might need to do. Okay. The questions. Let's go to preparing a NICRA proposal. There's a lot on here. Again, you're going to get a copy of this, so you don't take notes on it. But fundamentally, what do you do to prepare a NICRA? So number one is decide you want to pursue a NICRA. Okay, if you decide you want to pursue one, make sure you can check the box on the prerequisites because it does you no good do the work of actually developing a NICRA proposal, submitting it, and the government saying, we're not even going to review it because these boxes aren't checked. So in order to submit it and get them to review it, you must have a federal grant or contract. I mentioned that earlier on. You got to have accounting and timekeeping systems in operation. The single biggest challenge I see from small organizations or commercial organizations that want to do work with the federal government is a timekeeping system. If you don't already have one, it is a culture shock to implement one, but you have to implement one if you want to pursue work with the federal government and recover your indirect costs, period. It's actually required, and directly as well. And that's because labor is the largest component of cost, and timekeeping is the best way to assign that labor cost appropriately to where the work is, to what the work is being done. Now, having said that, I'm going to go on my soapbox again as a financial officer, operations guy. Ignore NICRAs. I think every organization should use timekeeping because it's the only way to truly know what your costs are. Otherwise, you get these large buckets of cost, no idea what people are spending their time on outside of anecdotal reviews and conversations. Timekeeping is critical to accurate accounting and financial tasking. I know that can feel like, oh wow, to employees, this feels like they're being spied upon. Someone's looking over our shoulders. I get it, but timekeeping is critical, and you need to have it. So if you don't have a timekeeping system, be prepared. If you submit a NICRA proposal, it will probably be rejected outright until you have one in place. All right, and you have to have those documented policy procedures. The auditors need to know how your systems work and what you do, and they do that by looking at the documented policy procedures, not by asking questions. The questions they ask you will be for clarification on those policies and procedures, not for how you do things. So have those things checked off before you do anything else. The data you need to gather, primarily financial. I'm going to pull the general ledger. Again, I've talked about what you need to have in it. Some awarding information, your timing data, your salary information. You want to pull that data. And then for documentation purposes, you want to have any grant or contact info, job descriptions, your organizational structure, basically org charts, any authority requirements or matrices that justify who can expend the cost on behalf of the organization, and any historical submission information if available. If you've submitted previously, you should start from that and have that available. I say pull this together because it's nice to have this when you start working on the actual calculations. All right. As far as developing a proposal, most agencies will have guidelines for you to download. So if you choose your cognizant agency or you know your cognizant agency, do a search on their website for a NICRA. Okay, a NICRA proposal. It will tell you what they want to see. It does vary in format, not in content or nature, but in format from agency to agency. That's the best recommendation I can give for you. So if you want to do a US aid NICRA, there are great documents to pull down. Department of State, same thing. Just use what they have as the basis for doing it. Fundamentally, what you're going to do at a high level is take your general ledger, all right, which if your chart of accounts segregates costs directly into indirect cost pools and allowable, you then can calculate from there. But before you do any adjustments. It might be an example of bad debt. It could be that there are the sub-agency or sub-awardee amounts greater than 25,000, whatever it might be. You make your adjustments. So you start from your general ledger straight out of your system, unadjusted. Then you make any adjustments, and you use your model to calculate the indirect rates. As I mentioned, pool and base. It's really not more complicated than that. So the actual calculation is not hard. What's hard is the accounting to make sure you have the cost collected appropriately, and the structure is set up so that you can do this readily. All right. And then no matter what you do in your proposal, even if it doesn't say you have to, I fully and formally recommend write a narrative to explain and support your data. The narrative, or basically the written Word document or PDF document, says, here's what we did and why we did it. The purpose of this is to speed the process, okay? It's to basically recognize that the auditor is not going to know how you do things. And even if they have your documented policies and procedures, they might not exactly understand why you do what you do. The narrative is the best place to do that. In my world, in proposals, I use the narrative to support and sell my numbers. And that's what you're doing here as well. You're using the narrative to explain, support, and sell what you did to calculate your indirect rates for the NICRA. Then you submit it. You are required, once you start doing this, to submit within 6 months at the end of your fiscal year. That's not the calendar year unless your calendar year is the fiscal year. I'm sorry, unless your fiscal year is the calendar year. But submit within 6 months. This is the big one. The average turnaround is 180 days. It's not quick. That's because there just aren't enough auditors. Auditor groups have been starved for resources for years, and so they're very limited in availability. And they're going to prioritize large organizations, critical organizations, or the ones that are the contents officers are screwing the most first. But the average turnaround is 180. So prepare that if you get your books done and you submit 6 months into the year, you're not going to get your NICRA until the end of the year. That's just the nature of it. And then be prepared for negotiations with the government, because It is called a negotiated indirect cost agreement. They're not necessarily just going to accept it outright, especially your first few submissions. They're going to negotiate with you. They're going to ask questions. They're going to make you change things or require you to change things in order to improve it. That's the nature of it. In every negotiation, you have the choice to either say yes or no, and that should be based on either an absolute position or a best business decision for you as an organization. But be prepared to negotiate. They sometimes can take a little bit of time, but usually, in my experience, it's done within 30 days and usually much shorter than that. The duration of 180 days is not they're working on it for 100 days, it's when they can get to it. All right, let me pause. I haven't had any questions in a couple minutes, just make sure there's none that anyone has before we go on to the next slide. Going, cool. All right, what do you do until you have a NICRA? This is what most of you are dealing with if you don't have a NICRA, okay? You have some options. Number one is there's something called the de minimis rate. And if you just Google search de minimis rate, there's a million articles about it. You can get all the detail you need, but a de minimis rate is literally 10% on modified direct total cost base. So if you don't have a NICRA, you can recover 10% on MTCC without having to provide any support or documentation. There's a few criteria points you have to meet, but most of you will meet those organizational requirements. But fundamentally, this is what you get to do. So it's nice because there's no support requirements required. You can do it as long as you consistently use it on all your bids and all your proposals, all your grant requests, or grant proposals, excuse me. So it's nice. The problem is it rarely covers all your indirect costs. So you're getting something back. You're recovering a portion of your indirect costs, but not all of them. And depending on your organization, that may be worth it for the short term. It may not be, but that's what you have to realize. And until you have a NICRA, 10% is the MTDC. I'm going to get to the red bullet in a minute, but that's what the de minimis rate is. In the near term, my recommendation is ideally, you as an organization, if you don't have a NICRA, you work under a grant recipient or prime contractor who has established grants and contracts. Basically, you subcontract or subaward. The reason is that you can more likely get the work because you're a level below the government. You might be able to negotiate terms with the prime contractor or the grantee. It does let you get in the door and it lets you build up your systems, processes, and history. I'm not trying to slow you down from going after grants or contracts. Just be aware there's a lot to it. And while it's not rocket science, and it isn't. It's just there's a lot of rules, regulations, and there's a lot of just institutional knowledge you have to learn over time. Now, if you have the individuals that have done it before, that's great. If you don't, sometimes giving up some work to have someone else that can lead it to learn from is the best way to go. All right, let's see the question here. We use provisional rates and send a rate adjustment invoice each year to true up the actuals. What would be the advantage of us to get a NICRA? Okay, the question there about the provisional rates. Let me hold this until the very end, Elise, but I will definitively answer that. It all will come down to how you got your provisional rates. So let me come back to that, but I think it's a good question. Okay, if I somehow forget to raise it in the questions and answers, please just repeat it and I will give you the answer. Okay. All right. So the cons as a subcontractor or subawardee is you might still be stuck with a de minimis rate. If the prime or the grantor says, no, since you don't have a NICRA, we're only going to give you the 10% de minimis, you may still end up getting stuck with it. All right. You can't guarantee you won't. But that's, to me, the best way. Now, the third option is what I recommend to anyone that is going to pursue work with the federal government and wants to be a prime contractor or grant holder that doesn't have one yet and has done all the prerequisites to have a system in place. I like to go ahead and calculate my indirect costs and submit a NICRA proposal anyway, recognizing the government will not negotiate something. So you don't have an agreement, but you submit a proposal. Reason is that when you submit grants and you submit contract proposals, you can include that NICRA proposal as an attachment, as a supporting information, and state, we have submitted this to our cognizant agency and auditor. This is what our rates will be. We are submitting this now so that you can evaluate it, and upon award, the government can immediately do a NICRA audit and review to negotiate our rates. It doesn't mean the government's going to accept this, but it very well might, okay? By submitting the proposal, they may accept your rates dependent on an audit, which means you can recover your costs at the beginning, and then if you get an audit, whatever the final rates that are agreed upon, you adjust to it. Or worst case, they won't accept it, but you've established that as soon as you get it, you're going to alter the contract or grant to incorporate your NICRA rates. So in other words, you're basically establishing that you are capable of doing it. I like this because it says to the government evaluators that you know what you're doing, that you have the capacity to actually do these things. It actually sets you apart from another commercial contractor or grantee or organization that doesn't have this kind of thing in place. And it kind of forces you to think about what you need to put into place before you get the big grant. In government contracting, it's the only place in the world where an organization can double its size in a day by getting a giant grant or a giant contract. And what ends up happening a lot of times is companies and organizations win that big job. They're, yes, we won this big job. Then, oh crap, we won this big job, because they're not really ready for it. By actually working through the idea what it takes to submit a NICRA proposal, you're really ensuring your accounting system is actually structured in a way that will let you take on that large new work and not have to then catch up to it later. Okay? That's my recommendation. I very much recommend the red bullet here that even if you're going to get the 10% de minimis rate from the green area, submit the NICRA proposal you would submit to the government and include in your proposal to the government for the grants or contracts. And you give yourself a fighting chance to either get the rates that you have in your proposal or get the quick turnaround on the NICRA negotiation. Pause that there. All right, let's see. Okay. Suzanne, I'm absolutely happy to, let's see here again. There's a few questions. Let me go back. Let me go in order. So again, Elise, I'm still going to answer your question in a minute. I just don't know why you get a rate. You can't go back years later and renegotiate a new one. What if things change? The original rate's no longer covering the indirect costs. Okay. So it depends on the nature of the agreement in that case. So the government, again, there's grants and there's contracts. Okay. In a grant, that's less of an issue usually. Usually you're getting your actual indirect rates. And you can recover them later. So you might be billing provisionally using a rate that's agreed upon for the time being until you have final rates for that period of time, and then you can go back and do it. That's common. In contracts, it's not as common because it might be a fixed price or time material contract as opposed to a cost plus. And in a fixed price or time material contract, the risk is on the contractor or the organization to manage their costs. The government says basically, you gave us a rate, we don't care. Now, can you negotiate? There's always the possibility of a scope change or a rate change. That depends on your relationship with your contracting or grants officer. It depends on the supporting documentation, the reasons why your rates are different. It depends on the available funds to the contracting officer or grant officer. So there's something that says you can't go back and try and negotiate adjusted rates. But the reality is oftentimes when they've actually awarded, they award based upon the amount of the proposal, and therefore that's what's funded. And so going for anything more requires them to go up their organization and ask for more money, which no one wants to do. That's the main reason why that happens. But again, in a grant, primarily normally in a grant or any kind of cost plus contract, it's institutionally built in that yes, you're going to bill provisionally during the fiscal period, but then when the final rates are done, you're going to either pay back the amount owed or recover or basically bill the additional amounts that were over. So it is possible. And Suzanne, happy to. NICRA, FIPRA. Okay, a NICRA and a FIPRA are for all intents and purposes the same thing. A NICRA for provisional rate purposes and a forward pricing rate agreement are fundamentally the same thing, just different terms in different organizations or agencies or by different individuals. I'm not saying that the exact structure and how you present those will be the same. Just that a NICRA is not the exact same as far as the format and structure goes across agencies, but the idea is you've negotiated indirect rates moving forward. One difference that I do see generally between a NICRA and a forward price rate agreement is a NICRA usually establishes one set of indirect rates to be used for the next fiscal year and up to 3 years. So a NICRA must be renegotiated every 3 years, but it can be more often. It can be less often than 3 years. So sometimes it's the same rate for the next 3 years. Whereas the forward pricing rate agreement, especially the Department of Defense, that'll oftentimes be a 5-year projection of rates, which could be different by year. Basically, you're budgeting out based upon your backlog, your new business possibilities, your historical run rates. And so that can be different. But for all intents and purposes, it is a negotiated indirect cost rate agreement or a forward price rate agreement that you can use for provisional rate billing and or proposal work going forward. Does that answer your question? Is that a little better, Suzanne, or am I just saying the same thing and you're not getting any kind of further detail? Oh, there's more messages. Yes, got it. Cool. Reality is you're going to probably have one term you use for your organization based upon your cognizant agency. Your cognizant agency uses the term NICRA, that's what you're going to use from then on. And if you bid work in a different agency that uses the term forward pricing agreement, you just state, we have a NICRA, which is this, which is in place of the forward price rate agreement. So you don't have to have both. You have one or the other. Okay. All right. Any other questions on this? We're getting close to the end. I apologize. I'm not going to miss Lisa's question, but let's do our last polling question to make sure we have the 3 checked off the list, Kate. At this point, do you feel daunted? Yes, no, a bit of both. Please go ahead and put that in the chat. Seeing B's and C's. Oh, good. Yay. Hey, look, folks, this is a webinar. It's an hour and a half webinar. It is an introduction to a topic. I could teach a class, a full 5-day-a-week, 8-hour-a-day class on this if we needed to. So don't feel like you're not getting it. You're the only person not getting it. Really, the idea, what I really want to get across was just some terminology and some ideas and some kind of structure for you so that when you come across this or someone asks about it or it's raised, you can refer back to this or you have some level of comfort going forward. So let's get to the questions and discussions real quick. And I want to answer Elisa's first and then we'll go, okay? No problem, Tracy. Thank you. Where did Elisa's question go? I'm going to roll back up here. Sorry, 1 second.
Elise said that she had, they use provisional rates and she wanted to know what the benefit was for them to use a NICRA.
So provisional rates, you can use provisional rates, depends on the organization. If an organization accepts or contracting officer or grant officer accepts, for example, last year's final indirect rates as your provisional rates for the next year, you're fine. You don't need a NICRA then in that case for that particular program, okay? Because they're accepted, they have something they're going to use. So that's fine. But what a lot of organizations will use the NICRA to develop the provisional rates. That's the point of this, is that's why it's called a NICRA provisional. If you have one grant or contract or multiple grants or contracts that accept your own last year's rates as your provisionals, go for it. You don't need to get a NICRA. Where a NICRA becomes valuable is if an organization doesn't accept your historical rates as a basis for provisional or doesn't accept your historical rates as the basis for proposals going forward. So it really depends on the situation. I hope that makes sense, Elise. I want to hear back and make sure that answers your question. I'm not trying to do it quickly, but that's really it. If you have established provisional rates, you don't need a NICRA per se, but you don't know if you'll need it when another grant or contract is awarded to you and that contracting officer or that grant officer doesn't accept historical as your basis for provisional. Let's go down and see if that got it. Gosh, there's a lot of answers. It's great. Business plan projections. Oh, so no, let me be very clear. If you have a NICRA and as your basis for provisional rate, as provisional rate, you still absolutely, yes, will be able to true up at the end of the year based on your final rates. A provisional NICRA does not lock you into those rates. You're not stuck with those. Basically, that's what you bill during the year or invoice during the year to the government. But at the end of the year, you'll do a final cost rate calculation. You'll submit that, and the over under. If the government paid you too much, you'll owe the difference. If the government didn't pay you enough, they'll pay you the difference. So no, absolutely a NICRA provisional rate can be nailed down to an actual rate at the end of the year. Be very clear on these, okay? All right, let's see. Yep, Tim, I'll get to your question 1 second. Let's make sure everything's good. That's got Elise. Having a provisional rate is easier. I mean, having a provisional rate, if you have a provisional rate, it's simpler. If you can use that, that's great. That's why a lot of small organizations don't go after NICRA's day one, right? But here's where it becomes an issue. If your provisional rates are higher than 10% de minimis and you're bidding on work and that grant opportunity or that bid opportunity does not accept provisional rates as a basis for the rates, you'll be stuck with that 10% de minimis until you get a NICRA. So it's kind of when the grants and contracts you're going after force you to, that's when you want to have it. But I'm a believer in get it done before you need it. So if you're going after work that will eventually require you to have that kind of information, do it sooner rather than later. But yes, if what you currently are working on and what you currently have is supported by a provisional rate and you're not pursuing work that won't be supported by it, it is the easier thing to do. Okay? All right, and then Tim, yes. So I'll start with fringe rates. The average fringe rate that I see for most organizations, again, it all depends on the benefits you provide, but the average rate runs in the 30 to 32% at the low end to the 36 to 38% range in the high end. Now that's for a standard organization that has 2 weeks of paid leave, paid vacation, 1 week of sick from you start, 10 paid holidays. They pay a big chunk of the healthcare costs, maybe all of the single person or whatever. There's a large amount paid for that. They have a lot of benefits, a full range of benefits for an organization. The fewer benefits you offer your organization, the more likely your fringe rate will be lower. Or the more benefits you offer for, say, like, again, a CBA, which could be in the 40 to 50% range, or non-exempt. So for a standard professional services organization in which all common benefits are offered and paid for by the organization, really the 31, 32 to 36, 38 range for fringe. okay? For facilities, there is no standard. I don't mean that to be flippant. It depends on the geography, depends on what you spend on space, depends on what is needed. If you're an engineering company that has to do a lot of work, if you're a lab company, if you're a cubicle in offices, it really depends. I don't have a great answer for you, Tim. I'd love to give you one. If you want to reach out to me after this webinar at some point and talk about, you can give me more details about your specific scenario and situation. I might be able to give you a better range on that one. But I'll tell you about facilities that way. For administrative, so here's the deal. Administrative rates do vary dramatically across organizations. Most start out with a very high G&A rate or administrative rate or overhead rate because they have a low base, a small base. And that could be in the 30, 40, 50% range. It can be huge. However, as organizations get larger, as they try to become more competitive, as grants or contracts be more competitive with them, most organizations work to try to be in a sub 10% range. Okay, they're trying to get below 10%, which not coincidentally matches up with that de minimis rate. That is when the government actually views it as being competitive. It's also when you might probably not be losing jobs or losing opportunities based on your total cost. Two ways to get down. Number one is to charge more things directly than you may be charging today. Number two is to grow your base. Really, that's the main thing. And then the third way is to cut costs, although I'm not a believer in cutting costs to profitability, but that's really what you're generating. So your goal should be to get to 10%. Maybe not this year, maybe not next year, maybe not 3 years from now, but the goal should be get to 10%. Wherever you are today is where you are, and work to either reduce it by moving more things directly or cutting them, or by growing your base. Hopefully that helps, Tim. And again, you have my email address. I'll go ahead and put up here for everyone because I know people have to start dropping off. You can reach out to me here. One thing I will offer up to everyone that's on this call today, if you have any further questions, if something comes up in the next week, 2 weeks, year, reach out to me. If I can answer the question without having to do research, I'll answer it. It's not a billable activity for me. I'm very happy to do so. I have people that take my classes reach out to me years later. It's not a problem. So please feel free to reach out. And Tim, for you specifically with a question, if I didn't answer what you really need, we can do so more specifically for you. With that, Kate, I think we're right up on it. Do you guys want to wrap up the webinar from your side? Or are we good to go? What do you want to do?
Yeah, I've got a few more things. Matt, if you wouldn't mind, drop your email actually into the chat.
I'll do it right
A
now.
lot of times our viewers will save the chat, so they'll have that. So that would be great. Thank you so much, Matt, for all of your time and all of your insights today. I think we all benefited from that. As a thank you to Matt and the McKelvey Group, please drop into the chat what your most important takeaway was from today. That feels like a really big question, but your most important takeaway. And as these are coming in, I'll go ahead and wrap us up. We do have an exciting summer webinar series for you. Please visit our calendar for upcoming webinars at www.ustransport.com/education. Take a look through any upcoming webinars you may be interested in and go ahead and register. And we will certainly see you again. Thank you so much, guys. We'll go ahead and finish up so you can get on with your day. Thank you. We look forward to seeing you next time. Matt, Jacelyn, thank you so much. William, thank you for all your help today. Thanks, guys. We'll see you next time.
Thank you, everybody. I appreciate your time.